CEO James Tisch came by Bloomberg yesterday. He was here talking investment, the drilling moratorium, and also a whole lot more. Here's what he had to say about private equity.
One of the biggest problems I see with private equity is that you put your money in and then you have to wait 5 or 10 years to get it back. My view is, what's the use of having money if you can't get access to it? And so we much prefer to invest in more marketable investments, equities, or even hedge funds where you can get out either on a quarterly or annual basis.
Interesting. So something a bit more liquid. I want to bring in the Bloomberg News reporter who interviewed Tisch, Cristina Alesci. And as it turns out, Tisch's dislike for private equity could be a trend because private equity itself, they're finding easy money harder to come by, right?
You're absolutely right. Thanks for having me on. Yeah, I mean, what Tisch said yesterday was basically that he's not in love with private equity. He's never been in love with private equity. What we're finding now and what Jason Kelly and I have written about is the fact that even investors who've loved private equity traditionally are actually falling.
And you're pointing to Jim because we're talking about pension funds, right?
That's
Which
right.
Jim knows a whole lot about.
Yep, we quoted one of the largest pension funds in our story today, basically saying that they are not going to be really making large commitments as they have done in the past to private equity. So
because these guys got burned, these pension funds,
well,
right?
The 2005 to 2007 vintage private equity funds have not done well.
Right.
But the thing that Tisch points to as a negative was really a positive when returns were high. When you were getting 20, 25, 30% returns, you didn't mind tying your money up for 5 or 7 years with an exit.
Yeah.
Now you're getting 30, 25% losses, and you're having problems getting your money out. And you can't get out. That's the big issue.
Right. So Tony James, the president of Blackstone, was one of the people that we featured in the story. We spoke to him at length, and basically he flew, this is a guy who a couple of years ago waited for his phone to ring, right? I mean, money was just, he had to turn people down, and now he's flying halfway across the country to get a $200 million commitment for his buyout fund. I mean, that just says something about the industry at large. And
why do I think some people might be amused by that anecdote, but widely amused by it, yes.
Equity funds were it was the investment vehicle that folks on the outside love to hate. The guys made a lot of money.
Right.
A lot of them cashed out early, and it was just buy a company, lever it up, get your equity out, and have it struck. And now it's sort of like they're getting their comeuppance.
Yeah, I mean, and you know very well, probably having been in pension board meetings, that these guys generally don't do too much pushback, right?
Oh, no.
I mean, Tony James went in there and got grilled.
Oh, yeah. No.
So they were asking him, why are your returns on your 2007 fund so down? I mean, what's up here? Like, why aren't we seeing what you promised we'd see?
Right.
So you've seen the drill.
But then for these pension funds, then, if they're not going to put it in private equity, then where are they going to put it?
Well, I've used the word now probably more in the last few months than I have in years, and that's the conundrum. That's the problem. Equities have not been a great vehicle. Clearly, you're seeing them now going to fixed income, but it's hard when you assume a return on your investments it used to be 8%, now it's ratcheting down to 7 to 6.
Right. It's
hard to buy a long bond at 3.5 or 3 3/4. So you're seeing high yield perform very well when they can get it. And you're seeing them really search for different ways to invest. Real estate has not done well. Private equity has not done well. So it's really sort of a recalibration of their thinking.
But this is, right, and this is the now. We're talking about the now.
Yeah.
But in the future, though, I mean, are these private equity firms, do they believe that this is going to come back for them, though, eventually? This is just a lull right now.
I mean, there are various sort of opinions on this, but I think all of the top CEOs and founders of these firms realize that they are probably going to be stuck in this lull for a bit longer than they wanted to be. Basically, they're facing pressure not only from getting money into they're facing pressure on the fundraising front, so their funds are getting smaller. At the same time, their costs are going up. Yeah. There's more regulation. They're hiring more people to do the marketing. So they're getting squeezed from both ends.
How does that affect, then, their current investments and, like, their plans to IPO, their plans to spin? How does that affect that then down the chain?
Yeah, I mean, public investors have not reacted too well to the firms that have tried to raise money in the public markets. So that's another avenue that they're finding a little bit difficult too, right? You can't go to the private investors and raise money. Where are you going to go? The public markets. Well, the public markets aren't too thrilled about these stocks either.
Right.
You know.
So,
But you're still seeing it, Cristina, as a solid business model, albeit with lower growth rates and lower levels of compensation.
Absolutely, absolutely. Private equity will be around for a long time.
Yeah.
Just a little bit different return expectations, probably.
all right. Cristina, great to have you on, as always, talking about the private equity industry.